I'm Georgina Jalbo from Lexis PSL Private Client, and I'm joined today by Chris Moorcroft, a Senior Associate at Harbottle Lewis, specialising in international private client law. And Chris is going to tell us about some considerations for wealthy foreigners buying UK residential property. So, welcome Chris, thanks for coming in.
Pleasure.
What do you think are the main issues for foreigners buying UK residential property?
Okay, well, there's a whole host of tax issues for starters. You have to think about SDLT, stamp duty land tax. You have to think about inheritance tax. You now have to think about ATED, which stands for the annual tax on enveloped dwellings, and I'm sure we'll go into a bit more. You have to think about capital gains tax. But it's not all about tax, and that's absolutely critical to remember. A lot of clients come to us with a fixed idea of what they want to achieve, and they want to understand the tax implications of that, but they don't come to us thinking about tax. So it might be that they want to achieve confidentiality. That's a very common one, particularly where a client is from a jurisdiction where they may be exposed to political risk or kidnap risk back home. They don't particularly want their details to appear on a public register showing that they own a very expensive property in London. And the other one is succession planning. So clients from abroad will not be used to UK probate procedures, will not necessarily understand them or want to go through them. So they may look to use structures for succession planning purposes to avoid probate, to make sure that the property passes to the child or other person that they want them to, and things like that.
Yeah, okay. And how have people dealt with these issues in the past?
Okay, so I mean, basically, until 2012, there was a fairly common way of structuring high-value properties for foreigners, which was that most people would use an offshore company, and they would use an offshore company partly because of the confidentiality, partly because of succession planning, in the sense that an offshore company could help you avoid probate, and sometimes an offshore company would have a trustee sitting at the top. But the other tax reason that offshore companies were used is inheritance tax, because if you're a non-domiciled individual and you have UK situs assets, of which a UK property is the most obvious, then that UK situs asset is within the inheritance tax net in the UK. If, however, you own the property through an offshore company, so what you own is not the property itself, but the shares of an offshore company, that removes your inheritance tax liability. And if we're being honest, along with the confidentiality and the succession planning, that was by far the most common reason for people to use offshore companies. And as a result, literally thousands of prime London real estate properties were owned by offshore companies in places like Jersey, Cayman, BVI, etc.
Yeah, but I understand the government brought in a number of significant changes in the Finance Bill 2012.
That's right.
Can you tell me more about these?
Well, it was quite an interesting time, because the government realised that there was something going on, that there had to be a reason why so many properties, high-end properties, were owned through offshore companies. But they didn't tackle the heart of the reason from a tax perspective, which was inheritance tax. So the obvious thing to do would be to have brought in some kind of rule that would just look through the company for inheritance tax purposes. But they didn't do that. What they introduced instead were a number of costs, effectively for the privilege of owning a property through an offshore company. So the first one is ATED, which stands for the annual tax on enveloped dwellings, very catchy. And that is an annual tax that certain offshore companies and other other types of entity have to pay now every year to the revenue if they own residential properties above a certain threshold. When it was introduced, it was above 2 million. It's now properties worth more than 1 million, and it's going down to properties worth more than 500,000. in April 2016. So that's the first thing, and that can be quite a chunky sum of money. At the moment, it's £7,000 for the 1 to 2 million bracket, but it goes up into hundreds of thousands of pounds for properties worth 20 million plus. So it's a significant sum. The other thing they brought in was a penal rate of SDLT for, again, offshore companies and other entities that acquire UK residential properties. And so that's 15% flat rate, which is quite a lot higher than the SDLT rates were at the time, and quite a lot higher than they are today. And so another big penalty. And then the third one is they introduced a capital gains tax charge on such structures, which hadn't been in place before. That has sort of been watered down a bit now, because we now have a separate regime for non-residents who own UK properties, and they're now subject to a separate capital gains tax charge. So the consequences of that aren't quite as significant as they were, but it was a three-pronged approach designed to attack these sorts of structures.
Yeah. And why were these changes brought in?
Well, that's actually a really good question, because the real sort of the real reason from a tax perspective that the majority of people went into these structures was inheritance tax, as I mentioned earlier. But funnily enough, when the government announced this in 2012, when Osborne stood up in the budget in 2012, he actually talked about SDLT. And so the story goes, and I can't be certain this is true, but the tale goes that the prospectus to One Hyde Park came across George Osborne's desk, and that apparently said in it that something about how you can avoid SDLT by using offshore companies. And the way that works is that if you own an offshore company which owns a property, and you decide when you come to sell the property that the company is not going to sell the property, but rather you are going to sell the shares of the offshore company, that's not subject to SDLT. Now, as it happened, not very many people did this, because buyers generally don't want to acquire the shares of an offshore company, or historically didn't. They'd rather just pay the SDLT rather than take on uncertain liabilities and all that sort of thing. So actually the government, we think, was sort of barking up the wrong tree a bit when they introduced this, and that might be why they didn't decide to go with the other option, which would have been simply to bring in a rule that looks through the companies for inheritance tax purposes. And that in many ways would have been simpler and more effective, but as it is, we now have all these different taxes to have to think about.
Right, that's very interesting.
Yeah.
So what options are now available to individuals considering purchasing property in the UK?
Okay, well, I mean, there are three main ones. The first one is that you buy the property in your own name or in joint names or whatever. So, you know, like the vast majority of people would buy their properties. But obviously that doesn't address the confidentiality issue, which is the biggest one for many clients. And it doesn't address a succession planning issue, so you would have to have, if you're a wealthy foreign individual, you would have to have a UK will. It also means that the property is subject to inheritance tax. And okay, there are various ways of dealing with that. So you could look at insuring against the inheritance tax liability. If you use debt to buy the property, then you should normally be able to offset the debt, although the rules in that area were also clamped down on. And there may be one or two other ways of dealing with the inheritance tax liability, but that is option number one, and that puts you outside this ATED regime, and it also puts you outside the 15% rate of SDLT. And then the other main option that people go for is to use the company still. So surprisingly enough, given how significant the changes were, quite a lot of individuals still use the company option because they like the confidentiality, they like the inheritance tax protection, they like the succession planning advantages. And even with these quite penal charges of the annual tax, which, as I say, can run into tens of thousands or hundreds of thousands of pounds a year, and even with the penal rate of SDLT, there's still a surprising number of people that buy through an offshore company. It is significantly lower than it was, but there are plenty that do it. So they are probably the main options.
Yeah. Are there any other structures that can be used aside from companies?
Yeah, there are. I mean, the most obvious one is to buy through trustees. So for the individual to settle, say, a non-UK trust, of which non-UK resident trustees are appointed, and then the trustees to purchase the property. Now, normally that was quite common, except they would have a company sitting in the middle, basically. So the trustees would sit on top and buy through a company. Now what we're talking about is having no company there. And some trustees aren't particularly happy with that because they liked having the protection, the limited liability of the company. But many trustees are happy to do it. It does raise a whole other load of tax consequences, as you can imagine. So it gives you the confidentiality, it gives you the succession planning advantages, it keeps you out of the ATED regime, so it doesn't lead to the 15% SDLT or the annual charges. So there's lots of ticks for the trust, but where you do have some complications is first with inheritance tax, because that structure you would generally consider it is known as a gift with reservation of benefit. So in other words, if the client is a beneficiary of the trust, which they normally will be if the settlor is a beneficiary, then they will be deemed to have reserved a benefit in the property, and so it will stay within their estates for inheritance tax purposes, which limits its use there. And then the other problem is that there is a 10-year charge on non-resident trusts which own UK properties. So this is the relevant property regime, which was actually really introduced in targeting UK, so UK resident, UK domiciled individuals that were tax planning through trusts. And these are the changes that came in 2006 and 2008. But as it happens, they actually also capture non-resident trusts settled by non-domiciled individuals, simply because there is a UK asset in the trust which is held by the trustee. So you will get, even though you get yourself out the annual charge, you bring yourself into a 10-year charge, which is up to 6% of the value of the property. And so that's not particularly helpful. So there's a huge amount of considerations to weigh up. And really it depends on the client's objectives. If confidentiality is critical for them, they might go with the company anyway. If the client's older, they may be prepared to pay the SDLT, the higher SDLT and the ATED for the benefit of the inheritance tax protection. Whereas if the client's much younger and of reasonably good health, it probably doesn't make sense for them to go that way. It probably makes sense for them to buy in their own names and maybe use a nominee company or go through the trust option and insure the inheritance tax liability, which would probably work out much cheaper than the annual tax. So it really does depend on what the client wants, and there's really no kind of off-the-shelf answer anymore like there used to be.
No. And just finally, what about structures such as partnerships?
Yeah, I mean, I know there are people out there who look at things like LLPs. I think Jersey LLPs are used for this. I'm a bit reticent about that, unless I think it's fine if you've got very clear, very good commercial objectives and reasons for using a structure like that. But if you're going into something like a Jersey LLP or something, you know, even more sort of obscure, I guess, I think in the current tax environment you're on pretty rocky ground. And so my advice to clients when it comes to structures like that would be, yes, we'll look at them if there's a good reason to do it, but I wouldn't generally be pushing a client into something like that. I feel like it's probably not in the best interest of most clients.
Thank you very much, Chris. That was a very clear summary of the issues and the factors to weigh up when advising clients. Thanks for coming in.
Pleasure, thank you.